Welcome to Exponential Finance, where we connect AI, crypto, and markets to help you understand what matters and how to act each week. Today, we're looking into the groundbreaking company, MicroStrategy.
All right, let's just kick things off with one single number, 641,250. Now, what is that? Well, that's how many Bitcoin the company MicroStrategy holds. We're talking about their corporate treasury, just packed with Bitcoin.
Now, to really put that number into perspective for you, that's over 3% of all the Bitcoin that will ever exist. Ever. I mean, we're talking about the entire 21 million coin supply. It's no surprise then that this makes them, by a long shot, the largest corporate holder of Bitcoin on the planet.
So, you gotta be wondering, right? How on earth did a software company, a software company, end up building one of the biggest corporate treasuries in the entire US? And maybe even more important, what in the world is their plan? What's the end game here?
Okay, so let's dive right in. We're going to break this all down. We'll look at their big Bitcoin bet, their perpetual accumulation strategy, what they call the digital credit factory, how they refine Bitcoin for investors, and of course, a new model for risk.
All right, Section 1, MicroStrategy's Bitcoin bet. We're going from a software company to a true treasury titan.
So get this. They've ballooned into the 5th largest corporate treasury in the US. That means they're sitting on more assets than giants like Nvidia and Amazon. Seriously. But they're not stopping there. Oh no. Their stated goal is to become the #1, the absolute largest corporate treasury in the next 5 years. They're aiming to overtake Berkshire Hathaway. It's incredibly ambitious.
So that brings us to part 2, the perpetual accumulation strategy. I mean, the mission is pretty simple: more Bitcoin. And they are not shy about this at all. Their leadership has made it crystal clear. They've said, quote, "We intend to continue buying Bitcoin into perpetuity." You hear that? Perpetuity. They're not day traders trying to time the market. They are pure accumulators, and it seems like their appetite is just endless.
And look, they're not just talking the talk. They have been walking this walk relentlessly. They started this whole thing back in Q3 of 2020, and since then, they have bought Bitcoin every single quarter. We're talking 17 consecutive quarters, 85 different purchases. That's some serious discipline and consistency.
Okay, so how do they actually pay for all this? Well, that leads us to Section 3, the digital credit factory. This is how the engine really works.
Yeah, their executive chairman, Michael Saylor, actually calls it a digital credit factory. And this is a really key point. They're not just taking the profits from their software business to do this. No, they have built an entire separate financial machine, and its only job, its single purpose, is to generate cash to buy more Bitcoin.
So here's how this factory works. It's actually a pretty simple 3-step loop. Step 1, they issue what they call digital credit. Basically, they sell stocks and bonds to investors. Step 2, they take all that cash and buy digital capital, which is just their term for Bitcoin. And then Step 3, the value that grows from that Bitcoin treasury is used to pay back those investors, either through dividends or appreciation. And then the cycle just starts all over again.
Now, this is where it gets really clever. The whole engine is incredibly tax efficient. We're talking a triple tax-deferred model. First, the cash they get from selling securities is tax-deferred. Second, the growth in the value of their Bitcoin is tax-deferred, as long as they don't sell. And third, even the dividends they pay out are often a special kind that are, you guessed it, also tax-deferred. It's a seriously efficient machine for growing capital.
So let's just quickly touch on that dividend piece. They often use something called return of capital dividends, or ROC. Now, a normal dividend is taxed as income right away. But with an ROC dividend, the IRS basically treats it like the company is just giving you a piece of your original investment back, so you don't pay taxes on it until you eventually sell your stock. It's a neat way to defer taxes.
All right, moving on to Section 4, refining Bitcoin for investors. So they have this massive pile of Bitcoin, right? But they don't just give you one way to get exposure. They create different products from this single asset.
The analogy they use is actually pretty great. They say to think of it like an oil refinery. A refinery takes in crude oil, this one raw thing, and it spits out all these different products, right? Gasoline, jet fuel, plastics. MicroStrategy does the same thing, but with Bitcoin. They take in their one raw asset, Bitcoin, and refine it into different financial products for different people. So this basically creates 2 main lanes for investors. In the fast lane, you've got their common stock, MSTR. This is for people who want high returns and are okay with high risk. It's basically a leveraged bet on Bitcoin. Then, in the slower, steadier lane, you've got their preferred stock. This is for investors who want lower returns but also lower risk. It's more like a fixed income product that pays a steady dividend, all backed by that same pool of Bitcoin.
And a lot of these yield products fall into a category called perpetual preferred stock. It's kind of like a hybrid security. It pays a fixed dividend forever, sort of like a bond, but it doesn't have an expiration date, and it trades on the stock market like a regular stock.
Okay, and this is the big question, right? This whole entire factory, this whole grand plan, it's all built on a single volatile asset. So that brings us to our last section, a new model for risk. We have to ask, what happens if Bitcoin's price stalls?
So what's the catch? Well, it's pretty simple, really. The success or failure of this entire model, this whole company strategy, it all comes down to what you believe will happen to the price of Bitcoin.
And, to their credit, they're really open about this. Their own models lay it all out. If you're a pessimist and you think Bitcoin's price is going to go nowhere, well, then there's about a 30% risk their whole system could become under-collateralized. That's pretty high. But if you're moderately optimistic and you think Bitcoin can grow just 10% a year, that risk drops way down to around 10%. And if you're a true believer and think it'll grow and become less volatile, the risk basically disappears. The securities start to look investment grade.
So here's the takeaway. MicroStrategy's whole argument is that the market right now is super skeptical. It's pricing their stock and bonds as if that pessimistic scenario is likely to happen. So they believe that for anyone who actually has a positive, long-term outlook on Bitcoin, there's a huge potential opportunity sitting right there.
And that really leaves us with the big question, doesn't it? Is this digital credit factory the future of corporate finance? A genius new model for how companies can use digital assets? Or is it just one of the biggest, most all-in gambles on a single volatile asset that we've ever seen?
If this helped, subscribe to the channel and visit exponentialtom.com, where we study all the technologies from the exponential age to improve our lives and stay ahead of the curve.